bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the July 16th, 2024 podcast. As our audience on YouTube can see, I'm here today with my partner, Kevin Wilson. This is not Kevin's first time on Tax Credit Tuesday to discuss year 15. In 2022, he was on to discuss issues that arise in considerations for LIHTC properties at year 15. Issues such as when to start addressing the year 15 matters, as well as the importance of identifying the goals of the partners at that point in the transaction. This episode is the latest installment of Tax Credit Tuesdays, So You Want to Be a LIHTC Developer series, a series that strives to give our audience insight into the process of developing, financing, and operating affordable rental housing properties, from conception to placement in service and beyond. Now, Kevin and I will cover the beyond part of that statement in today's episode. We're going to discuss GAAP accounting issues that arise in year 15 transactions for long-compounding tax credit developments, GAAP being generally accepted accounting principles. Now, year 15 marks the end of the initial tax credit compliance period for a low-income housing tax credit development. The tax credit compliance period, as those who listened last week know, is the 15-year term over which an investor is subject to recapture of their tax credits if the property fails to comply with tax credit rules. The end of year 15 is often when investors plan to exit the partnership. Now, this is the second installment of our two-part mini-series on the topic. Last week's Tax Credit Tuesday episode was with our partner, Nicola Pinoli, and we did a deep dive into 3 of the many possible paths that occur when year 15 arrives. I do encourage our audience members who haven't yet listened to or watched that podcast to go to the Novogradac website, go to our YouTube channel, or go to your favorite podcast platform and listen to or watch that episode. Now, in today's episode, Kevin and I will discuss issues and concerns that both investors and developers commonly have with regard to generally accepted accounting principles or GAAP accounting at the end of year 15. I'll also note that having awareness of the accounting issues that your partner might be dealing with can facilitate and accelerate successful negotiations surrounding year 15 transaction exits. Now, before we dive in, this is a good opportunity for me to remind our listeners who want to expand upon what they hear in today's episode that they can visit the Novogradac website at novoco.com and order a copy of the year 15 handbook that we publish. We recently released a revised and updated version of the handbook, and Kevin edited the accounting portion of that guide. Surprise, surprise, I'm having you on the podcast to discuss accounting issues at year 15. We have a lot to discuss, so if you're ready, let's get started. Kevin, welcome back to Tax Credit Tuesday.
Thanks, Mike. Yeah, happy to be back. So second time here, second time doing year 15. You might think I like this topic or something.
Yeah, I think we might that, but I'll also say that since your last one was in 2022, hopefully your next one's not in 2026.
And then the other thing, just to kind of set the table here. So we're going to be talking about accounting. We're going to be talking about generally accepted accounting principles a lot. We're going to abbreviate that. We're just going to call it GAAP. So when you hear us saying GAAP, we're not talking about a space between things. We're talking about generally accepted accounting principles, which is what entities use when they're preparing their financial statements. So,
right. Thank you for that. GAAP, G-A-A-P, not G-A-P. So now while we're discussing year 15 today, that's one of the many areas of expertise that you have. Please share with our listeners, before we get started with the core of the podcast, some information about the services you provide to Novogradac clients.
Sure. Yeah. So I do a lot of audit and tax work at that for over 20 years now. We also do a lot of consulting, right? So we do a lot of consulting for both developers, and we do a lot of investor and syndicator consulting. I'm talking specifically in the affordable housing space right now. So as accountants, consulting services often that can be a pretty broad term. So just to be a little bit more specific, like on the developer side, we do a lot of, we call them feasibility studies. We help them run numbers during the development phase or at year 15, just to kind of run different scenarios to see what those might mean to the different parties involved. We also do a lot of work just helping our clients understand new tax laws and new federal or state affordable housing regulations and guidelines or strategic planning. And again, consulting for us, it can also just be as simple as being an on-call resource who's ready for you to call if you have questions, or as you're doing a deal, or as you're working on a transaction and questions come up, accounting technical issues come up, and we're here and happy to help with those.
Great.
So,
Thank you, Kevin.
I'll also say, well, the focus of this is on GAAP accounting. We do a lot of work. Sometimes a lot of these transactions are based on tax credits and tax incentives, but there can be some fairly complicated GAAP accounting issues that arise when you're applying those standards to a particular transaction. So we also do a lot of work, again, with developers and investors to help them apply those standards to those transactions and document why they're doing it that way.
Great. Thank you for that, Kevin. Now let's dive into today's topic. Now, if an investor is preparing to exit a tax credit partnership, then most assuredly, the investor, particularly if they're a publicly traded corporation, they're also evaluating how exiting the partnership will be reported and otherwise reflected in their GAAP financial statements. Now, to understand how an exit will be reflected in their GAAP financial statements, it's useful to start with how the investment is currently being reported in their financial statements. And in order to know how they're currently reported, it's important that developers and investors, obviously investors know, or at least someone within the corporation knows how they report their financial statements. But it's also important for developers to understand as well to help influence the negotiations in a positive direction. So I thought it'd be useful as a level set, Kevin, if you could explain the various ways in which low-level capital transaction could be being reported by investors on their GAAP financial statements.
Yep. Yeah, that's a good point. I'd like to kind of take a look at this from a couple different perspectives and just kind of remind everyone that who's listening that regardless of which side of the table you're on, I think considering and understanding the accounting issues facing those on the other side of the table should generally help make for more productive negotiations. So with respect to the investor, I think in a traditional LIHTC, again, we're starting at the property level partnership. At the property level partnership where the investor is the limited partner, traditionally, I'd say that the investor is going to account for their investment using, I'm going to go over 4 possibilities under GAAP, right? All of which are going to be distinctly different from what they're doing on the tax return. But so for GAAP, the 4 that I'm going to go over are, we're going to talk a little bit about the equity method. We're going to talk a little bit about proportional amortization. We're going to talk a little bit about consolidation and the cost method. Probably spend a little bit more time talking about the equity method and then maybe proportional amortization because they're either most commonly used or have some interesting aspects to talk about there. So for starters, in order to determine which of these methods should be used, you kind of have to start, A, you got to understand the GAAP accounting standards, but B, you got to look at the partnership agreement, right? Because the partnership agreement is going to assign various rights, responsibilities, and obligations to the different partners. So in simplified terms, I think the determination of whether the investment should be accounted for by the investor under the equity method versus the consolidation method, it's generally going to hinge on which party has the controlling financial interest. And when I say the controlling financial interest, I'm talking about how that term is specifically defined in GAAP. So, and it can get a little complicated because the partners have varying interests. They have variable interests in these partnerships and varying rights, and they can be different from partnership to partnership. So in most situations, though, I'd say that the most common scenario results in the investor, especially if the investor is kind of a syndication group, utilizing the equity method of accounting. But it's still important to understand the other three methods and how, why, and when they might be used, and how that might change the look of things at year 15. But with respect to those other three methods, first I'll talk a little bit about proportional amortization. And so proportional amortization in general is a method that would be seen by most investors as kind of the ideal method for LIHTC investments, right? And so as a reminder, under proportional amortization, instead of recognizing the investor's allocable share of losses, credits as an above the line, the losses as an above the line expense, they could instead amortize the initial cost of the investment in proportion to the realization of the tax credits and benefits below the line as a component of income tax expense / benefit, right? So this effective netting of the profit and loss activity of the investment through income tax expense could help investors avoid the less desirable placement above the line. And it kind of aligns more with the economics of this tax incentivized transaction with the accounting in a more appropriate manner. So not all investments are necessarily eligible for that proportional amortization treatment. GAAP guidelines kind of outline certain eligibility requirements, and an investor that's a syndication fund versus a corporate direct investor, that something like that's going to impact this decision. And whether or not the investor has chosen the equity method or proportional amortization method on their financial statements, generally, it's important to know and it's important to understand, but it's also something that is really not going to impact the property level partnership or the other partners in the partnership. So
Just here, when I think about the cost, equity method, proportional amortization, and consolidation, I tend to think of consolidation as like a first mitigating question: is does the investor have controlling rights or protective rights? And if they have protective rights, they don't consolidate, and they're controlling right. And this is a gross simplification. And that's like their initial sort of threshold. And then if the cost method is something that is seldom seen, and that you would basically just be reporting it on your balance sheet, essentially cash in as cost is an asset, and cash distributions reduce the asset.
yeah. The only thing I was really going to say about the cost method, again, because it's generally not going to be relevant in this context. But the one thing that we do see sometimes is when an investor is using the equity method, right? They record an asset on their books for their investment, and then they're allocated profits from that investment.
Wait. So when you say the cost method, and then the next step is from the cost method, you're basically it's cash in, cash out. And the equity method is basically saying, but you flow through your share of entity level loss.
Yeah.
That is like an additional entry cost method as a general matter. And then that equity method create bad optic because you get book losses above the line and you get your tax benefit below the line. So your pre-tax earnings are showing losses from a tax credit investment, whereas your after-tax income is showing the benefit of the credit. And that's where portion amortization became a special rule that originally only applied to LIHTC. Now it's more expansive. That may let you take those above the line book loss equity method, move them below the line. And then obviously your balance sheet ends up reflecting these different approaches based upon that.
Right.
So with that as background, I interrupted you, but I just wanted to kind of break it out in that fashion.
Yeah. No, yeah. I was just going to say back to that, the cost method, the only time we really see any of that is derived from, we start with equity method and you get loss allocations that over time get to an amount that exceeds your original investment and reduce your investment account balance down to zero under the GAAP standards. If the investor has no obligation to fund additional proceeds to that investment, they would generally start to suspend those loss allocations. And at that point, they're essentially using the cost method. They're not recognizing the losses or suspending them. And then they're recognizing income for any distributions that they receive. So
That's a good insight that the equity investment, once you get enough losses, converts to the complementary.
right.
Sure, because obviously if you don't have obligation to put in additional money, you shouldn't be showing a negative investment account. That'd be equivalent to having liability and you don't have liability fund. So maybe you could say a few words about developer accounting and then we can move on.
Or I'd like to talk a little more about consolidation too, because we do see that a little bit, right? And I think it's particularly relevant here in the context of year 15 because of one of the mechanisms that we see investor consolidation through, which is sometimes, again, back to that partnership agreement, understanding where to look in that partnership agreement and understand the different rights and obligations and things like that that are assigned to the stakeholders and the partners. But sometimes we see situations where, again, a lot of the partnership agreement is geared towards the tax credit compliance period in year 15. And sometimes we see rights where starting at some point in time close to year 15 or around year 15, around the tax credit compliance period, a right will become effective whereby a limited partner can cause the partnership to sell the assets, right? I call that a sale. We call that a sale right. And it's interesting when you again, we're looking at the GAAP definitions for all these terms like controlling financial interest and things like that. Generally, the general partner is going to be in control, but there are situations where a limited partner's powers can sort of overrule the general partner's powers. And GAAP had to be pretty thoughtful about what they considered a controlling right. And one of the things that they clearly define as a controlling right is the right to cause the entity to sell their assets, right? So if we see that sale right for a limited partner, that could cause a shift in the accounting at that time that right becomes effective, where consolidation might be required. So
No, it's a good point. I so often equity method that you may not always be on there.
yeah. And even kind of piggybacking on one of the topics that you guys discussed last week with the qualified contracts and how that can be sort of a hot button issue. Sometimes the partnership agreement not only will give the limited partner the right to cause the partnership to sell the assets, they could also have the power to go through that process to dispose of the property through the qualified contract process.
So anything else on investor? You want to go to developer now?
We can go to developers. Yeah. So, I think when we're talking about the developer here, again, just being able to consider your partner's perspectives and the broader impact of the accounting considerations, right? And that could help form a more strategic conversation about these year 15 plans.
I would
think-
think for our listeners that when we talk about developer, we somewhat interchangeably use developer and general partner of the property partnership.
Right.
Oftentimes, in most cases, the general partner and the developer are different, distinct legal entities, oftentimes blowing up into the same entity, maybe not. So when we're talking about this interchangeably, the entities themselves do matter to these questions.
And there could be multiple general partners and multiple limited partners too, right? And,
Yes, exactly. So we're dealing with that developer, general partner, somebody interchangeably, and investor as a single entity. And as you were noting, it could be an intermediate syndication fund. So it pretty quickly gets complex, but there's only so much time in the podcast. And we want to talk about the sort of general sorts of issues. And if you're ready, Kevin, we can move on to some of the individual matters that we identified when we were doing the podcast. So when Kevin and I were preparing for the podcast, we identified 4 investor-focused issues and a couple of developer-focused issues that we wanted to discuss today. And as you've already intimated from all that we've talked about so far, we can talk about a lot more. And another reason to buy the White 15 handbook and read the accounting section. But the 4 issues that Kevin and I wanted to particularly focus on with respect to investors and their sensitivities at year 15 deal with impairment, exit taxes, whether or not they have a positive GAAP account, book purposes, and proprietary internal management reporting that corporations will have. And let's start with the impairment. And if you could describe or explain to our listeners what impairment is and the relevance of that at year 15.
Yeah. So I think that's going to be particularly relevant, especially in situations where investors using the equity method of accounting, right? And they're going to have to every year when they're preparing their GAAP basis financial statements, look at the investment basis on their books and consider whether or not any undiscounted future cash flows that they may end up getting from that investment, which could include future tax credit allocations, it can support that asset balance on their balance sheet, right? And if they end up in a situation where the undiscounted future cash flows may not support that asset balance, they may need to write that down, right? And we call that an impairment charge, right? And it's facts and circumstances based. There's inherent subjectivity in that analysis because you're estimating things. You're estimating undiscounted future cash flows, right? And so that's just something to consider.
And that's something that does relate indirectly to having a positive account of purposes. So maybe we can talk about that next. And a positive capital account for GAAP purposes basically means for listeners that at year 15, there's still a balance for GAAP purposes on the balance sheet, on the asset side of the balance sheet of the investor, which basically means they not impair the asset completely.
Yeah.
Was talking about the impairment charges. It's all about every year assessing whether or not it's the asset balance as stated recoverable through future cash flow, through tax credits, through various benefits, economic benefits. And if it's not, it gets impaired down to that recovered balance. So in year 15, the asset might on the GAAP books be already written down because of the flow through of GAAP losses.
Right.
the equity method or amortization, it's kind of amortized down, or there have been sufficient impairment charges to get it to zero, or in case not zero. In many cases, it is a positive balance. So if you could explain it.
Yep. And you'll be able to see that. So one entity is going to have that investment on their balance sheet, if they're doing equity method, but then the property level entity, when they prepare their financial statements, they're going to have a statement of capital or a statement of equity. And that balance that's assigned to the limited partner in that statement should track closely with the investment balance on the investor's balance sheet, right? And if that number is still positive, right, then that's assuming it hasn't been impaired yet, then that's indicative that there might be some future value there to uncover, right? It also could be an indicator that, remember back in our last podcast, we talked about certain liquidation issues and waterfalls in the partnership agreement and the safe harbor in the treasury regulations about making liquidating distributions based on tax capital accounts, but seeing a large GAAP capital account that's positive at the end of year 15 could still be an indicator that those tax capital accounts are also positive. They're going to be a little bit different because property's generally going to be depreciated over a shorter life for tax, but there is a correlation there.
No, it definitely is, but maybe a whole podcast over income tax basis capital account, 704B, regulation capital account, and GAAP capital accounts. So we won't do that today. There's definitely a relationship that you point out and would be an interesting podcast, at least for tax.
Yeah, I was just kind of thinking that you could look at that GAAP capital as sort of an oversimplified indicator, easily observable. That's hard to find. So,
but I assume that you agree that the relevant impairment is whether or not that the partner has your investment partner has written their asset down to zero or not, and that the positive GAAP capital account is a reflection that they haven't, and that the implications of that is that if the investor were to leave at that point in time for a cash amount less than that positive balance, they would show a GAAP loss.
yes.
And that probably motivates them as a general matter to not necessarily want to exit yet, without it getting at least cash equal to their positive capital balance.
Yep. Especially if there's earning sensitivities there, right? And that could go beyond the folks that are making the decisions at the syndicator, because there's anytime you get into these capital events, the deal for the first 15 years, it had a pretty steady, easily predictable stream of earnings that were flowing to whichever parent companies that had interest, right? Easy to predict is good. But anytime we get into this volatility or these large fluctuations, that can be problematic kind of further up the chain. So,
and at that point,
how that impact is going to play out.
And at that point in time, the investor, broadly speaking, can say, I want to recognize the loss now. I'll wait and get the cash distributions to recover the balance that GAAP purposes, I believe I would get if I hang out long enough.
Yeah.
And then, or basically get additional GAAP losses allocated to me every year, and basically that balance would burn off over time. So
Yep.
let's turn now to, we've done the impairment, positive capital account. Let's talk about exit taxes. What should listeners bear in mind with respect to investor considerations about exit taxes?
Yeah. So exit taxes, there's a few things I want to talk about here. Again, go back to that partnership agreement, right? Because we see a wide variety of ways that these partnership agreements, waterfalls, are designed to compensate the various parties for exit taxes. And I guess I should just remind or just sort of refresh everyone as to what exit taxes are. which is generally from, again, on the tax perspective, these partnership agreements are designed to sort of maximize loss allocations to the investor. I mentioned for GAAP on the equity method, when you get down to zero, you'll start suspending losses. It's not necessarily the case on the tax side, right? Where you can continue to receive loss allocations and the benefit that goes along with those loss allocations, so long as you can support that loss allocations, not just with your capital account, but with your proportionate share of the partnership's minimum gain, right? So then you get loss allocations that reduce your capital account to a negative amount, and then you go to exit the partnership and you have to go from a negative amount to zero. So you have to debit your investment and then credit income. And then that taxable income can generate some exit tax liability, right? So again, on the GAAP side of things, that large income hit that you were going to recognize on the tax side may not necessarily occur if you've been suspending losses, right? But then you will, if assuming you're not a partnership, ultimately these credits and losses are going to a corporate taxpayer. On your financial statements, you need to account for income taxes under ASC 740. So you would still have that income tax liability, which you may have already reserved for, but you won't have the corresponding GAAP income from writing your investment up to zero because you've already been holding it at zero from suspending those losses.
And just to unpack that a bit. Sorry, I was over speaking. I've done that a few times at podcast, trying to do better. That for GAAP purposes, if you're getting allocated losses and then you're spending them for tax, you're allocating the losses, and for tax purposes, you're actually saving tax dollars. It's just you're creating a reserve on your balance sheet to deal with those benefits. That then when you ultimately pay the tax, it comes out of that reserve on your balance sheet, so you don't end up showing income or loss from the treatment of the exit tax. And so as a consequence, in that situation, an investor might want to stay in longer to avoid paying the taxes from a cash perspective. But from a perspective, they wouldn't necessarily be recognizing any income or loss in the partnership. Is that
right? Yep.
So let's go to the fourth issue, which is we've talked about GAAP in terms of impairment, exit taxes, positive capital accounts. Now we're talking about internal management reporting, which is basically non-GAAP reporting. You could explain at a high level internal management reporting and how that can govern investor behavior in ways that a developer partner may not appreciate directly.
Yeah, this can be a tricky one to understand, right? And even talking about the accounting perspectives, we were kind of talking about how it's sometimes you don't know the broader impact for the other stakeholders. Well, I think this is something similar where each organization may have, in addition to their tax accounting, in addition to their GAAP accounting, they may have internal metrics that they use to evaluate whether they're doing what they're supposed to be doing. And these internal metrics could have a strong impact on if there's multiple strategies, multiple decisions that are on the table at year 15, they could sort of tip the scales one way or the other. So some organizations might use completely different metrics than other organizations, or they could be using the same metrics, but they might weight them completely differently, right? And so just having strong relationships and having good conversations with your partners throughout the process can kind of help everyone sync up and stay on the same page.
Now, that's what I liked about the podcast that you're on before. You talked a lot about kind of understanding, communicating. And this is one of those situations where communicate is pretty important. And all you can really do if you're the developer side, general partner side, is ask the investor what are their key metrics, what is their goal with respect to the various options, and so that you better understand what their corporate goals are and what their internal management accounting reflect, and that can oftentimes lead to decisions that you wouldn't predict given the GAAP consequences.
Right.
So let's turn to the developer now. We've talked a lot about the investor, and most listeners will say, yes, these are public traded companies. I know they care about GAAP financials, GAAP revenue recognition, and all the rest. Developers, they tend to be smaller sized organizations, but they also many have GAAP financials. As we talked about in the current podcast, nonprofit client developers generally pretty universally are preparing GAAP related financial, and most developers are, but not quite as uniformly as nonprofits. But that being said, when we were preparing for the podcast, we talked about two critical questions. One, when the general partner or when the investor leaves the partnership, the impact that can have on the general partner GAAP financials. And then the other one has to do with some revenue recognition issues if the developer general partner is planning a resyndication. But with the general GAAP consequences at a very high level, if you could just explain the general GAAP consequences, the general partner / developer when the investor leaves the partnership.
Sure. So again, just to set the table, we're kind of going to assume in this case, that the general partner, the developer, has the controlling financial interest and has had that from day one and will continue to have that going forward, right? So the way that kind of works is they have the controlling financial interest, but if you look at the percentage of profits and losses, they're getting 0.01% of the profits and losses and contributing 0.01% or less of the equity, right? So that equity shows up on their financial statements as a non-controlling interest. The equity that represents the equity interest of the investor. This is on the parent company consolidated financial statement, the developer entity that consolidates however many tax credit property level partnerships that they control, right? You'll see this large non-controlling interest is a positive number, at least on day one, from all those equity contributions coming in. And then that gets reduced based on their allocable share of the losses over time. But then when the investor exits, depending on how that exit transaction is structured, you might see a distribution and then any remaining balances transferred to controlling interest, kind of all within the equity section of the financial statement. So it's not really going to be a profit or loss item generally that I can think of.
What if the general partner developer is not consolidating?
Then like in the situations I mentioned above where the sale right had kicked in, it's almost going to be like they went from having a non-controlling interest because they weren't consolidating to having a controlling interest, right? And so there's a recognition of it there, assuming that they're now getting the controlling interest. They're going to basically look at that as a business acquisition, and they're going to recognize all the assets and liabilities that they're now consolidating and that they acquired at their acquisition date fair value.
Basically, it gross up on the balance sheet, as you were mentioning earlier, which we're not going into other implications, but there could be implications with that combination, things of that nature. So it is something that developer or general partners want to be mindful of in terms of what the implications of this are across the broader platform.
Yeah.
So let's turn now to a more narrow topic. but equally important one that I know you get a lot of questions about, and that is the general partner syndicator is the owner that have the controlling interest of this partnership. And then they're looking at it post year 15, and they're looking to resyndicate in the sense of maybe 5 years later, after 20 years, 25 years of owning the property, they want to do a renovation of the property to deal with replacing roofs and things of that nature. And they're going to go and reapply for tax credits and get productivity bonds and do the resyndication.
Yep.
What are some of the GAAP related questions that you get from
Yeah, no, I like this one. This is a fun one.
I love it.
We're seeing it
Again, because the listener going, you love it.
We spent a lot of time talking about this, and there's some interesting things that start to happen here, right? Especially on the GAAP side. Again, it's all kind of goes back to it depends on who's in control, but starting with that assumption that general partner's in control before and going to be in control after, it just as bad as context. So with resyndications, which is becoming, it's a pretty common year 15 strategy. I know you guys spoke about that quite a bit last week. Just a reminder, for tax purposes, a resyndication is generally going to be structured as a sale of the assets from the existing owner partnership to a new partnership, right? And so in order to maximize and qualify for the acquisition credits, that needs to be structured as a sale to an unrelated party, right? And for tax purposes, again, which is going to have a different definition from GAAP, the threshold that we're using here is 50%. So for tax purposes, the common ownership threshold or the common ownership among the buyer and the seller is 50%. And it's not necessarily just that profit and loss allocation. It's anything, right? Whether like cash flow, waterfall distributions, you kind of have to be considerate of all those aspects, right? And so you do that for tax purposes, and then the new partnership that buys the assets, they record the assets at what they paid for it, right? What you would expect, right? You're going to get credits for that amount based on that basis, right? But on the GAAP side, right? And then the seller's probably going to recognize some taxable income or loss, depending on what the basis is and what the sale price is. But on the GAAP side, there's this concept where one party controls the seller, and then that same party controls the buyer. You don't recognize intercompany gains. You don't recognize sale proceeds or losses or anything like that. What you do is you have the basis of the asset in the hand of the seller, just carries over to the basis and the asset on the buyer's balance sheet, right? And the difference between the sale price, which you recorded on your tax return, and that sort of historic basis that carried over from the seller is a large equity adjustment, usually a large equity adjustment in the financial statements of the buyer.
Great, thank you. Thank you, Pat. It's obviously a very complicated topic, but I tend to think of it as it's for GAAP purposes, you're not selling it to yourself, that you're consolidating it. You can't recognize gain selling assets to yourself.
Right.
To develop a different revenue recognition policy that takes into account the economic accretions sort of over time, as opposed to recognizing the event if you were to sell it to an unrelated party.
Right.
Now that's a gross simplification.
And we usually see when you're preparing the financial statements that have this, we've seen some pretty thoughtfully drafted footnotes that kind of explain what's going on here, just so that the readers of those financial statements realize what's going on and why they're seeing there might not be what they were originally expecting, which is what they saw in their tax return, which is the basis of the property listed at what they paid for it, right?
That's good. So thank you for that, Kevin. So we're at towards the end of the podcast, but before we work away for our sort of closing comments, we mentioned the handbook earlier. That can be a Y15 handbook that can be purchased at our website, novogradac.com. That's not the only resources we have around dealing with year 15. So please share some of the other resources our listeners who might want to learn more about year 15 can access.
Well, sure. So, we're halfway through summer now, so we're gearing up now for the fall conference season, right? And the first one we have is about 2 months away now. We have a 2024 Housing Tax Credit and Bonds Conference in late September in New Orleans. So I just want to let everyone know about that. And again, we're here. We're an on-call resource. You can reach out to me individually if you have questions, or I think my contact info will be linked in the podcast notes. And yeah, the year 15 handbook, we did make some pretty substantial renovations to the GAAP accounting chapter, not just to add some new content, but also just because the standards are changing, right? And we noticed that since the last publication date, some of the key accounting standards had changed, like lease accounting, which just changed last year, right?
Right. Thank you for that. And another resource I'd add is the locally temperate working group, which is a great way to bring up issues and join a wider community that speaks with one voice and comments on treasury regulation and on GAAP guidance and the rest. And just generally a good way to learn more about what's going on in the locally temperate development, operation, and financing and export world. So please Google the locally temperate working group Novogradac, and I'll take you there. You'll learn more about it. I'll also include a link in today's show notes. With that, before we go to our off mic section, I did want to remind the audience to please subscribe to our podcast on whatever platform you prefer. And I also encourage you to share the podcast with your colleagues so they can learn more and help support the show. Now, let's quickly go to the off mic section. And our regular listeners know this is a space that we use to give a shout out to someone working in the various tax credit, community development, incentive areas where Novogradac works. And it gives us a chance to highlight someone who really deserves recognition. And there's a lot of great contributors across the country. So we're never going to run out of people that should give a shout out to. But our weekly guest, gets to identify someone they want to give a shout out to. So Kevin, this is your opportunity to give a shout out. Please take it away.
Thanks. Yeah. So I'd like to give a shout out to Ray Pearl. So I'm based in California, and I'm on the board of California Housing Consortium, which is a nonpartisan affordable housing advocacy group that does some pretty remarkable work here in California. Ray has been at the helm there for, I believe, a little over 15 years now, and he's done some tremendous work to help support preservation and production of affordable housing here in California. So I wanted to give Ray that shout out.
Great. Thank you, Kevin. And I'll echo your shout out. Ray Pearl has been around, been doing God's work for many, many years and for many years to come. So thank you, Kevin. Thanks for being on the show. It was a pleasure to have you back. Don't stay away so long next time.
All right. Thanks for having me.
And to our audience, I'm Mike. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify,